collections, coming in at $46.3 million, which is 23% up on the last year's Q1. We've guided the market to a 20% increase PCP on this half's cash collections, and obviously we've been set up well there. ARR growth is very strong. K12 business, we've gone through what was a massive sales period June last year. The Crispin's team have done an outstanding job, not only selling new logos, but we're seeing signs of a real uptick in cross and upsells, which is really important for the future of this business. We'll talk about that in coming quarters about our cross-sell journey, products per customer, metrics like that. You'll hear a lot about that from us soon. But again, a highlight, which we've talked about for a couple of quarters now, is Qustodio. Now we're putting a little bit more money into that business. It is taking off with ARR growth across the group of 25% year on year, but the Qustodio business growing at 33% on an annualized basis. Generated free cash flow of nearly $12 million, which is 50% up on last year. And we're not only reiterating the guidance that we provided last quarter, but we've now upgraded the guidance to $145 million. So, a fantastic start to the year. Let's go through it in a little bit more detail. I think it's, again, worthwhile highlighting not just good financial results, but we're literally impacting lives of communities across the globe and schools, 8 million parents rely on us to look after 27 million kids more on our platforms than there are Australians in the world. And we make every couple of hours. So everyone who's an investor in our business and this business, thank you so much for your contribution. From a kind of key metrics perspective, nearly touching on $150 million, but I think we're there today. Cash receipts, $46 million, which is higher than I think was most analysts expected, delivering for us $12 million of free cash flow. We ended the quarter with $24 million of cash and net debt, comfortably under $30 million. And we'll just put a highlight here, with the pipeline being largely emptied as of June. Crispin's marketing and sales teams have done an outstanding job on that, and in fact have generated a record pipeline of that at the moment. All segments, except for maybe the UK, but we've spoken about the UK will have access to all of our products by starting in March with the kind of launch of the Qoria platform. Most of what we know as the US products, or the Limelight, will be able to be sold in the UK. So very excited about the back end of next year in the UK and beyond being a growth market. But outside of that, all comfortably north of 20%. And Qustodio, last 12 months, 26%, but in the last quarter, the growing annualized basis, 33%. So US is questionably the dominant part of our revenue, and if you include half of Qustodio, which is US denominated, that's comfortably north of half of our revenue now denominated in US dollars. Probably a clearer view of vision to our ARR growth. We had a little bit of volatility through that, but over the quarter, it only negatively impacted ARR. Main contributions is new logos in K12. Existing customers, nearly caught up with new growth, so cross-sell and upsells, nearly caught up with new logos. Had a bit of churn. I think Ben might touch on this, but we've decided to focus the Octopus business on our new product. So we've brought forward some churn in that business with Go to products. So that's all very well managed, still comfortably around the percent or less churn in the K12 business. And Qustodio added $0.4 million, which is a massive increase on where they were last year. I'll turn a second. This chart shows, I love this showing, is the cash collections that we deliver each year over the last 4 years. And you can see the clear falls in our invoicing and cash collections, but you can most importantly step change in our, essentially, the revenue, invoicing and collections in our business every year. So I think it's a fantastic graph, and so you would expect our Q2 December quarter collections to be significantly above the $30 million that you've got here. And really that's what we're trying to guide to the market with these. The K12 business, as I said, a great contribution from K12, not only in new logos, which is really in our hunter mentality, but also Kristen's team's getting much better at cross-selling our ever-expanding range of products. I think last year, correct me if I'm wrong, Chris, it was something like 20 to 10% of new business was from cross-sells, and this year we're comfortably expecting that to be 30% or more. So very excited about that. All regions contributing, but in particular, Australia is on fire, entering Australia's key selling period, Australia and New Zealand's key selling period, which is the quarter. So cross-sell and upsell was a highlight for the quarter. A massive reseller channel in the US called C, which has recently signed on, awarded us as their education partner, is a very unexpected but a very significant win by our US organisation. We've finalised plans to launch the Qoria capability into the UK. As I said before, that'll be launching beginning in March through the year. I've touched on Australia. The POC pipeline's enormous. We're doing amazing things in New Zealand. I touched on that in the last quarter, but I'm sure we'll follow up on that in the coming quarters, the success of that New Zealand. I would highlight the average sales price, which is essentially the average order value, so the kind of the Australian dollar value of our average order. You see that's come down, and that's not untypical. September quarter isn't the biggest selling period in the US. It's typically that Q4, and so that's nothing to do with. You'll see that following that typical cycle again through the year. But all in all, we're feeling very confident of doing materially better on what was a record last year. We'll be doing materially better than that this current financial year. Crispin, he'll be answering questions on it. Crispin and I were just in Utah with a team who are just absolute professionals, and they're all set up for success. So a lot of eyes are really now on Qustodio. I think the market is finally starting to get to grips with the opportunity of this business. We've been restraining it somewhat through, I guess, lack of access to capital, but now our business has turned to profit and cash generation. We're shipping, and we're not talking about big dollars. We're maybe talking about $3 or $4 million of extra money over the year, and it's instantaneously generating growth. The one that I'm really excited about is the subscriber chart on the bottom left. You're seeing a very substantial uptick on a PCP basis in subscriber growth, and on a net ARR growth period, I mean, something like a 60% increase PCP on ARR growth in that quarter. I mean, that's extraordinary from what is quite a modest increase in investment in that business. And on the top chart, obviously that's translating into ARR over that business, a very, very big jump in that September quarter. Yes, September is the start of back to school in the US, but we enjoy a lot more of that, plus the key retailers through Christmas. Black Fridays and Christmas are key kind of tech time frames in retail. So very excited for the Qustodio business are going to deliver in the quarter. One little highlight is the community B2C proposition in the US is unquestioned to contribute to brand building and the kind of our cost of acquiring that business. And we've now accounts have been referred from that business, and so that's a stellar success. But overall, the metrics in this business are proven tremendous. So looking forward to talking to the market more about January. Now, good growth and discipline in costs has delivering profitability, profitable growth, profitability, and the dropping to the bottom line. Our fixed cost as a percentage of ARR is consistently coming down. I might add, Ben Jenkins, our CFO, will probably touch on this in a moment. The July-August period, we do have a lot of annual subscriptions, and we do have pay reviews coming through. So there was a jump, but you should see that flatten out over the year. And so the fixed cost as a percentage of ARR should be through the quarter, through this financial year. So all good there. We're definitely on plan in terms of contribution. Nothing changed here in our SaaS metrics. Is still a standout for our business. For every dollar spent, we get $8 of ARR. Essentially no bad debts. 25% ARR growth. So all looking good there. And then we've already touched on this. Our weighted pipeline has returned. Our pipeline has returned. Sales and teams have been sending out the emails and hitting hitting their phones and building that pipe into, the key selling period in the UK, as everyone knows, is the period in the June period for the US. So getting prepared for that, really good spot to shoot, higher than we did last year. That was very, very quick, 10 or 11 minutes, and everyone's busy, so I might just now hand over to Ben before we get questions.
Thanks, Tim. Probably won't spend too much time on this slide because I think a lot of this has been covered up. So we'll jump into the next one and get into a little bit more detail on the costs within the business. Obviously, the cash collections have been touched on. It's a good result, up 23%. Strong collection period, touched on before. Direct costs, largely growth related. There's a little bit of FX impact in there, but as we've talked about previously, they're not linearly connected to revenue, so we'll continue to grow at a much smaller rate than revenue, which helps that operating leverage that we've talked about. Marketing costs have obviously with the investment in Qustodio, but it's really performing. We can see the results there, and it's giving us confidence in those growth and the revenue numbers moving into the rest of the year. Staff costs is probably the main one to touch on. Obvious first point is Octopus BI wasn't part of the business last year, so there's around about $250,000 worth of debt that needs to be normalised for a like-for-like comparison. The other large impact was some chunky redundant, about $450,000, and then FX of $750,000, which is largely out of the Spanish and UK businesses with the Aussie depreciation against those, which makes the period comparison a little bit out of whack. So that's about $750,000 there. So take those bits out, and the wage growth is CPI plus a little bit, which is a few growth heads to support the growth in the business, but again, growing at a much lower rate than top line, and will continue in that form. As Tim touched on earlier, not expecting another big jump. It should start to flatten out from this point onwards. The other one that's pleasing is, and we've talked about this a little bit before, is the effort that's gone into hardware costs and the efficiency there. So we've added significant ARR in the education business over the last 6 months, and the amount of hardware that we've actually spent on hardware is significantly down, which is a great outcome. In theory, that should increase with revenue, but the team's done a great job of being more efficient in the way they purchase and install that hardware, so that's a good outcome. And fixed other is up a little bit, but it's small numbers overall in the grand scheme of things. And again, will continue to remain largely flat and increase that leverage that the business is starting to show. So that's probably the main things that I wanted to touch on, Tim. So we can probably jump to questions now.
Yeah, cool. Okay. Over to you, mate.
All right, Lindsay, let me sort out the microphones.
You can now unmute yourself by pressing *6.
Lindsay, you should be able to turn your microphone on now.
Okay, hopefully you can hear me.
Yep, gotcha.
Beautiful. Yeah, thanks, guys. So the first question is on the waterfall chart you put in. I think it's slide 7. Like, understanding that Q1 is not seasonally the strongest quarter for the education business, but even if I go back and have a look at like the PCP, so like Q1 last year, it looked like the K12 new was about $3 million. That's kind of come down. K12 existing was like $2 million. That's come down. So like in the conversations I've already had this morning, there's a bit of a narrative that like the consumer business has kind of saved this quarter, and maybe the education business is softening. Like, could you just either bless that logic or just shove us down for us and explain kind of what's happened, please?
Yeah, I wouldn't say that. Chris, do you want to add some colour?
Yeah, I mean, the strength in the June quarter, we brought forward some deals that were expected to close in the September quarter. I would say that's probably the biggest rationale here, but yeah, I mean, the US alone generated $5 million of pipe this quarter, Lindsay. The cross-sell and the upsell story is incredibly strong. There was a large deal also that is still in play that was expected to close last quarter, which, so I'm not all personally concerned. I don't know, Tim, if you had anything else to add to that, but no, it's business as usual.
To jump in with a little bit of detail behind it as well, Lindsay, we've probably done ourselves a disservice in some ways by adding a decimal point at the request of a few investors. So last year, the cross-sell upsell in the September quarter was 1.6 million, but it rounds to 2, not to 1, when you're not using a decimal point. And then in new business, it was just over 2.5. So again, rounds to 3 rather than rounding down to 2. So it's not actually that different year on year when you put another decimal place in there.
Okay, very good. No, I've been using like a chart reading software in the past, so I had kind of those numbers, but mate, that's good. That's helpful. Just on consumer, so like Tim, you're obviously pretty impressed with the consumer like new user growth, because I think like that per your chart you put in, that's been pretty flat, and like most of the growth's been pricing. So like new users is good. Maybe the other piece of consumer is like the churn. Like a lot of new users might see like an uptick in churn in the consumer business. Like, are you seeing anything there? And maybe just talk about churn in the consumer business as a whole, because like that's just structurally pretty high, I think. Like, is there anything you're doing there to bring that down?
Yeah, so when we merged with Qustodio in 2022, their average churn over the 12 months, remember we merged, I think, August, September, and that period, so we've just gone through that now, is the key churn period for that business. Yeah, because they're doing annual subscriptions. So the key selling period is also the key churn period. Their churn back then was 38%. At the moment, it's comfortably under 30%. And over the course of last financial year, it was about 26.5%. So the team there have done an outstanding job improving the reliability, the stability, and the feature sets of that product, making it easier to use, easier to solve your kids' problems and harder for your kids to get around. And there's still a ton of work to do. So we've got, high confidence that plus the fact that we've got schools promoting Qustodio to parents of younger kids, we've got high confidence that we'll see significant increases in LTV, which is a function of, again, the age of starting your parental control contract and the churn factors. So, yeah, I think they're doing an outstanding job. You'll see churn, progressively in that business fall through the year now, and then kind of lift in that September quarter again and fall again, but trending downwards, which has been doing that for 3 years.
Okay, very good. And then just final question, if I can get it in a third, the UK unification and like the launch there. I thought previously the commentary had been around like calendar year 26. I was thinking it was going to be kind of early in the year. You're now talking March, pushing into June. Like, has that been pushed out at all, or did I just misunderstand that historically?
It's a stage. We're rolling out a sequence of capabilities. Essentially, I don't really want to give too much away because our competitors are probably on this call. All of the capability will be available essentially in the UK market around about March, but we're offering it to different segments in stages. So let me kind of leave it there, but yeah, it won't be available to all of the segments in the UK probably until that last quarter, the December quarter, but it will all be available, in the early part of next calendar year.
Very good. All right, thanks guys. Cheers.
Thanks, Lindsay. James, you should be able to turn your microphone on now.
Hey guys, congrats on the results. Maybe just touching a bit further on the ARR, I think there was a comment that the record in FY25 will be beaten in FY26, or there's a fair level of confidence around that. Maybe just sort of confirm that for us and talk us through the driver and the confidence in terms of you guys giving that guidance to the market, just considering the current quarter was in line with PCP.
Yeah, cool. So you essentially need to separate our business into K12 and consumer for this discussion. The consumer business, it's somewhat core and operated, right? That business is about trying to optimize your cost to acquire through all sorts of channels. And you've seen now, I think, 3 quarters in a row, that business is really starting to get that mix right. So, I'm happy to say we're budgeting for that business to grow at 30%. And so far, they're on track to beat that. K12 is different. K12 isn't about pouring money into a funnel. It's about identifying sales opportunities, literally account level, allocating that to individual salespeople or success people, account managers, working with the product teams to make sure that we've got the proposition and the products that those customers are looking for, and then setting a go-to-market plan, what's called a motion in the US. So the reason we've got confidence is because now we've gone through that mechanic, that budgeting and planning mechanic for like 4 or 5 years, and we've got incredible visibility about the opportunities in that market. We've got an incredible sales team. Every single salesperson, as of a couple of weeks ago, knows what their target is. They're carrying a number. They know what they're targeting. They know the region they're responsible for, and they're just going to execute. So we've done that every year for like 5 years in a row. So I think I've forgotten the number that we added of ARR last year in education. I think it was like $24 million or something like that. So Crispin's team have been given a target, which isn't our budget, but a target of materially higher than that, and our budget's somewhat lower than that. Yeah, they'll just go execute.
Definitely, and good to see that weighted pipeline pick up again as well. And just on the UK unification, I mean, is that fairly material in terms of the expectation of what you're expecting to pick up in ARR, or is it around the edges type thing?
Next year, it's all about retention. So it's going to our existing customers, basically, and bringing them on the journey of what Qoria means and what this product and platform means for them. And then essentially doing what the US team has done so brilliantly, which has been turning existing customers into advocates and sell around them. So next year is bringing existing customers on the journey, demonstrating the efficacy of this product set. And so I think the new logo growth story in the UK will be more of a 27 picture. Next year it's about, as I said, conversion into the new platform, cross-selling, particularly the monitoring product and filtering products. Because the filtering capability that's come to that UK market is astounding. And yeah, as I said, new logo growth in the subsequent calendar year.
Excellent. And last one from me, maybe for Ben, just on the cash cost growth as well. Just remind us what's expected there on a normalised basis into 26. Just conscious there was some one-offs, and you're seeing strong growth on the revenue side as well that was upgraded. So just any comments on the cash cost growth outlook?
Yeah, I'm still in line with what I said previously, in that sort of 6 to 8% range over the whole year when you take out any noise from FX and those sorts of bits and pieces. So well and truly lower than revenue growth.
Excellent. Thanks, guys.
Thanks, James. Owen, you should be able to unmute now.
You guys got me okay?
Yep.
Good one. Just on Qustodio. So the 1.5 million increase in sales and marketing year on year in the quarter, how much was related to Qustodio?
The majority of that would have been related to Qustodio. Yeah, very, very little. Maybe a little bit of spend in education, but rounding error type level. Yeah.
And the ARR you're adding there in Qustodio, just talk me through when you're selling that product. Is the percentage of that is 1 year up front? You guys to recoup the CAC. What percentage is paid up front per year?
100%.
Okay, so you cover your CAC straight away, and then 2, 3, 4, whatever it is, LTV to CAC says year 2 and year 3, you recoup. Good one. Just going to the last quarters, Ben, a bit more of an accounting question, just understanding the reclassification of costs from direct into staff. Can you just maybe go through some changes that you've...
It was not direct into staff. What we did was we split the marketing costs out of direct, so that's really obvious. So historically, we would put marketing and all your data and hosting costs into the direct line. But as we're making that investment in marketing, it makes sense to take the two apart so that you can see the data and hosting costs are tracking at a level that's much lower than revenue growth. The other change that we made was to bring everything from the 4C into that table on slide 16. Historically, we hadn't included the Qustodio capitalised salaries because that wasn't part of the accounting change, and a few other bits and pieces. But for the sake of just making it easier for everyone to reconcile between the two and see everything in one spot, we've gone through and basically restated all the historicals to the same format as what we included the September quarter in. So now every single cash flow item in the actual Appendix 4C sits in this table.
Yep, good one. Like that. Now, the weighted pipeline there of 10 mil, the percentage of that, can you guys give a geographic split there, the percentage that's the US is the UK starting to build yet?
Yeah, it's predominantly the US that are in. UK pipe is definitely building, but I would say if you look at us across Australia, New Zealand, the US, UK, the US probably represent 65 roughly % of that. Probably a small portion, 5% in ANZ, and then the rest in the UK.
And you said on the call there around a large opportunity slipping from last quarter into this quarter. Is that inside that weighted pipeline?
No, we removed those lumpy larger deals out of the pipeline.
And how many are there, I guess, expected to close this quarter?
No comment.
Go on.
I don't know how much I should say here, but yeah, we're still actively involved in those conversations. And just to touch on a previous question around, confidence in the year ahead, like we've made a number of structural changes in the US, one being having a single head of sales, another being having dedicated strategic and technical account managers to handle our largest accounts. The other is, if you recall, if we've talked about this, we've now got a head of strategic accounts as well. And that individual is going after the top 100 largest districts in the US. So that individual, along with partner relationships, is having meetings with districts that have, anywhere from 100 to 400,000 students. So yeah, I can't recall if I said this previously on the call, but have a goal within the US to close an additional 6 of the top 100 accounts in FY2026, which again I'm quite confident we'll be able to achieve.
Gotcha. Okay, well done. That sounds good. And then the last one here, you said 30% growth in Qustodio is kind of where you expect to hold for this year. That kind of assumes, call it 9 odd mil increase in ARR. Is that what we should expect in terms of increase in sales and marketing?
Well, look, I think we just need to play it by ear. The marketing spend is going to be going up in our budget of, I think, $3.5 million every year, and we're predicting that will take the ARR growth from, I think, 7 last year to 10 for Qustodio. The first test was the September quarter, passed with flying colours. So we have confidence in delivering that kind of, let's call it guidance, if you will. But again, as I've said before, if the business outperforms, particularly in cash flow and EBITDA, if we save money somewhere by not hiring someone or what have you, then we're encouraging Victoria essentially to spend it and turn that into growth. So that's literally going to be a weekly, if not daily, decision about how do we optimise the growth in that business. So I look at that 30% as kind of our base level, but if funds allow, we're going to try and shoot beyond that.
Good one. Makes sense. Thanks, guys. Well done.
Thanks, Owen.
Thanks, Owen. Wei Sim, you should be able to unmute now.
Hi, can you hear me?
Yep,
Gotcha.
Cool. Just in terms of the revenue upgrade that was put through from 140 to 145, can you just remind us, what visibility we have into the FY2026 revenue outlook and what gives us the confidence to put through this guidance upgrade?
Yeah, the visibility is pretty strong, and I think like we touched on at the call when we put the original guidance out, the 140 was relatively conservative. With the only thing that could really go wrong to make it drop below 145 would be FX. So I think we're now almost 4 months through the year. Qustodio in particular is growing strong in the first quarter, and that revenue kicks in straight away. So all those things put together has made us confident that it's not going to be below 145. So we're happy to lift that guidance.
Okay, got it. And then just in terms of slide 9, that bottom left chart, Tim, you kind of mentioned it. Do you mind just walking us through a bit more in terms of why that number's not a worry?
You're on mute, Tim.
Yeah, Chris, do you want to maybe cover your thoughts on the September quarter and why ASP isn't such a focus?
Yeah, I mean, you covered the cyclical nature of the business there, but it's also just the nature of the deals that get closed. And, you know, in Q4, we had a large number of tier 5s that closed. And, you know, those are $100,000 to $200,000 deals. We didn't have any of those that closed in Q1, hence why the numbers dropped. Like I said, that one large opportunity, if that had closed last quarter, then that number would have been significantly higher. So it just comes around the type of deals across, you know, the smallest up to the largest districts, Wayson, that we're working on. For me, it's more about making sure that we've got sufficient pipeline and more to meet the FY2026 goals. So for me personally, I'm not too concerned about, you know, the ASP dropping in the September quarter. It's just making sure that we've got enough deals, which, as Tim said, are allocated out. Every single sales rep has a target, channel, inside sales, and marketing all outperforming. So, yeah, this is not something that keeps me awake at night.
Okay, got it. Last one from me is just on Qustodio. I think the numbers were pretty strong this quarter. Are you able to give some color as to what's been driving that regionally?
Yeah, well, one of the brilliant things about that business is we can sell internationally. Some of our competitors are very much US focused, and so, you know, if they're buying search terms, right, that's how SEO works. If you're buying you know, essentially competing to find parents who are searching online for, you know, how to block porn. And sometimes that can be expensive. And so a secret of Qustodio is that we operate in 11 languages, and so we can find customers anywhere that's, you know, it's cost effective. And we can also hijack local things. Like the best example of that is the Adolescence Netflix TV show. When that launched in the UK, that turned into rivers of gold for our UK consumer business. So that's the kind of base level, is they get to spend anywhere where they can find a customer at a certain price. Now, added to that over the last couple of years is what's called middle of the funnel marketing. So finding parents that are sort of aware of the problem but aren't really in a mood to buy it right now. And so these are things like, you know, TV talk shows, you know, webinars, social media marketing. We're pouring money at the moment into Reddit and TikTok and Instagram and so on with influencers. And that's really starting to work. All of us in the industry are starting to pour money into, you know, AI-based, generative AI-based search, and that's now, for us, starting to really contribute. And then finally, our B2B2C and telco and affiliate partnerships, you know, so promoting through, you know, tech magazines online for the top, you know, credit control apps in 2025. So those sorts of partnership-driven marketing efforts are also bringing customers to us from different parts of the funnel. So it's all those measures are aimed at essentially qualifying and managing your CAC, and our cost to acquire a customer is, I think, industry leading, and unquestionably industry leading at around about $50 to $60. So yeah, it's all of those measures. The big difference in that Qustodio business over the last year is it was very much performance marketing, so SEO-based marketing a year ago, and now we're using all those kind of mechanisms to manage the CAC and bring customers to us.
Thanks, Wei Sim.
Yeah, thank you.
Wei Wang, you should be able to unmute now as well.
Hi, guys. Yeah, so a couple of questions from me. The Qustodio is making, I guess, quite a meaningful contribution now to your ARR dollar growth, and we established previously with on the other calls that you're expecting to grow sort of 30% or say sort of 8 to 9 mil over the year. What's the seasonality we should be thinking about this ARR growth? You did 2.4 in the first quarter, so that's say 6 odd in the next 3 quarters to hit your target. Is that kind of spread evenly over the next 3 quarters, or are there certain big ones and small ones?
Yeah, no, typically it's the second half of the year. It would be 60%. Would that be right, Ben? 60% of the ARR growth in Qustodio will be coming in that December half?
December half, yes. Yeah.
Yeah. Yeah. So yeah.
Yeah.
Yeah, so it's not equal each quarter. There's definitely an orientation towards back to school, Black Friday, Christmas. Those periods of time where parents are required or do buy devices is definitely the key selling point. So let's say it's 65%, so 35% will come through in the January to June period. So yeah, we've essentially told.
Less than 55, Tim. Sorry, not
55.
55.
Okay, cool.
Yeah.
So we've given Vic a license, Victoria, who runs that business, a license to go for it this half, and we'll see what that does in terms of growth, cash costs, EBITDA impact, and then we'll kind of play with our levers in the second half of the year to make sure that we hit revenue, ARR, and revenue growth and EBITDA guidance. So that's what I'm really looking forward to, the January conversation. Talk to the market about what that business has achieved and position it for the way forward.
Yeah, cool. And then another sort of quarterly based question for me. So in the PCP, you generated all your free cash flow in 1Q, with the other 3 quarters kind of negative. How should we think about the remaining 3 quarters for this year? Are you planning for second quarter to be positive?
Yeah, that's right. And then third and fourth will be negative again.
Yeah, okay. All right, cool. Thanks, that's all from me.
Thanks, mate.
Well, there's no further questions, Tim, so if you want to wrap up with some closing comments.
Yeah, cool. Thanks, Chris and Ben, for attending. Thanks for the questions from the analysts on the call. That's always great. And thanks for all the investors being part of this journey. Yeah, I think everyone is very clear on what we're planning to do this year. 20% growth, 20% EBITDA margins. We're committed to that guidance, and Q1 test I think has been passed with flying colours. So I'm looking forward to seeing you all again in January. Thanks for your time.
Thanks, everyone.